in years past, the bond world wasn't as exciting, but we've seen a lot happen in fixed income here in the last couple of years, especially last year. But really happy to have Steve Thompson, who's our senior client portfolio manager of our investment grade bond suite here, to go through another session focused on the fixed income side of the house. So Steve, thanks for being here. Talk to us about the investment grade bond suite and what makes your team unique.
Yeah, well, again, I'd love to have you come back some other day when I come up here around and see our floor. We have deep research resources. We've got a great portfolio management team. I think we have 12 portfolio managers, the investment grade team, managing institutional money, stable value money, 401k plans, and then the mutual funds you see up here. So short-term bond, core plus, corporate bond. We manage other ETFs, SMAs, kind of a growing space we manage across the platform. But they're all kind of variations on a theme. But you're getting our best ideas from institutional clients from across our platform into all these portfolios.
So Atlanta-based, and then Sergio talked a little bit earlier, about the equity income fund, right? The bond portion.
Bring that up.
Yeah. The bond portion of equity income is managed by Steve's team. So they're the ones that are managing the bond side of the house for. So another thing, reminder in terms of what makes it.
One of the less exciting part of that portfolio. The stability, just trying to generate the simple bond returns, all the equity side and the tier returns.
Talk to us, obviously last year was a super rough year for bonds in terms of, just give us a little kind of what happened and what are expectations as we move to the rest of 2023 for bonds.
It's a rough year for everything. But we went through a period from 2008, 2009, until about 2021, where interest rates were close to zero. That's great if you're borrowing money. You want to borrow very cheaply and buy a house at 3%. But it wasn't great if you're an investor or a saver because you earned, 2-3% on treasuries, maybe. You know, corporate bonds, maybe 3 or 4%. We had a big regime change in the last 18 months, let's call it. Actually, it didn't start till last summer. I'd say the Fed started increasing rates in March of last year from just 0.25% rates of nothing. They really started to raise rates dramatically in June. But the bond market was told this was coming, realized it was coming, and all of a sudden you saw interest rates start to climb pretty dramatically. Even in January of last year, mortgage rates were at 6% range pretty quickly from threes, and that shut down the mortgage market. So it was a tough year last year for all asset classes. But with rates going up, all of a sudden you've got yields on bonds in the 5, 6, 7 range. I haven't talked about 5, 6, and 7s for yields on high quality treasuries, corporate bonds, agency mortgages since 04, 05. I mean, we're talking 20 years ago. It's been a while. They've been in a low rate regime that long. And so finally investors get afraid. And everybody's been telling me they want 5% yields. They had to buy high yield and junky bonds, right, a couple years ago to get 5% yields. Now you can get high quality bonds that money market funds pay almost 5%. So that tells you everything. And you can buy corporate bonds that pay you 5.5, 6. So all of a sudden we've got this opportunity that we've had in a long time. And I think it's going to stick around for a while. I think the Fed will probably raise in July here to 5.25. Maybe one more time they told you maybe 2 are going to happen. So get the 5.5. That's the peak for short-term rates, and then they're going to probably start coming down. I'd say spring to summer of next year, you're going to start seeing short-term rates start to come down. The long-term rates here, the 10-year Treasury right now is about 3.8% yield. That's probably going to be range bound in the 3.5 to 4 area. So you can still get a lot of yield off of the Treasury, but corporate bonds will also get you another yield on top of that, so called 5.5 to 6. So that's I think you're going to get that for a couple of years, and that's going to be pretty attractive.
And this is, so again, in that navigating volatility deck, it's another slide that we have that, I showed you the one with stocks. We have the same one on bonds. So calendar year returns going back, I think it's 1989 again.
Yeah.
Same thing, shows you what the bond market has done every single year. And by and far away, we can say, well, look at this year. I mean, complete outlier in terms of performance when you go back, really 40 years. But moving forward, it gives you, Steve had mentioned, confidence in, hey, the market's going to come back and we've got some great opportunities. Which kind of leads me to the next question. I think a lot of times, folks would ask, like, hey, all this volatility can create some opportunities. So right now, in strategies, what's the team doing to take advantage of some of the opportunities you guys have seen recently?
Last year's kind of opportunities across the board because we just saw yields go up. This year, I'd say March 2023, you started to see some banks having issues. Credit Suisse falling apart, Silicon Valley, First Republic, Signature, a couple other banks that disappeared pretty quickly. Outside of Credit Suisse, which is a foreign bank, all those U.S. banks that went into bankruptcy, they were kind of below the $250 billion limit for deposits, which is where they have to do stress tests. They kind of fell below the line. All the bigger banks, JP Morgan, Bank of America, Wells Fargo, Fifth Third, PNC, Truist here in Atlanta, SunTrust, those are all quite large banks. They have stress tests. They have to go through government quarterly analysis of what happens if the world falls apart, what happens if rates go up, what happens if defaults increase, what happens if your consumer portfolio, commercial portfolio falls apart. So those are actually great for us bondholders because maybe not so great for equity holders because if they don't pass those tests, they can't pay dividends. But for bondholders, that's just another layer of protection for banking. And so banks start to fall apart, bank bonds, even JP Morgan bonds started to big in March. They started buying the PNCs, Fifth Thirds, the Truist bonds. We saw 6, 7, 8% yields for 1, 2, 3, 5-year bonds, which is shocking. That's like the high yield levels. Just because people were just selling, just selling. Just wanted to show whoever they were investing for that they didn't have bank exposure, and that was the time we started picking up some of those bonds. So those have started to grind in pretty well. You're getting a big coupon, getting a big yield, plus you're getting some price appreciation. So that's been a good trade for last year. It was painful at the time. It was a big drawdown for everybody exposure. But you got to kind of wade in and do your credit research and then start buying into this opportunity. If you don't, you miss those. And then as they tighten up, as those bond prices come back up, we'll start taking that risk down a little bit again, and then we'll start adding it back next time we have another crisis. Something else is going to break. The Fed hikes 1 or 2 more times. More stuff will break. That's what they want to do. They want to break stuff and slow the economy down and slow inflation down. So something will happen. We just don't know what it is.
Sure. You know, we always say that the term, hey, history doesn't repeat itself, but it tends to rhyme. In past market environments where we've seen downturns in bonds, you know, what can we expect, or what do you typically see moving forward in terms of bond markets?
Yeah, I think about, well, more recently, 2018, the Fed was hiking. They walked in December 2018, they said, I think the Fed funds rate got to 2.5%, all of 2.5%. But the economy was growing at 2%, inflation was 1.5%, so I'm not sure 2.5% on the Fed funds rate. But investors were happy for a moment on their money market funds. They started to cut into the summer of 2019, because again, the economy wasn't growing that robustly. So that's again a period where bonds had a horrible fourth quarter of 2018, but a great 2019. And so people think about bonds, they say, well, maybe, you know, bond used to be 3%, now it's 6%. And they think, oh, I'm just going to get my 6%. Well, but as interest rates move, the price of that bond moves. And so you get these, that chart's around, you get these, the volatility of the bond market. So you can get 2% drawdown and a 6% upside in a given year. That's kind of normal. It's normal way you'll see. That's all rate driven. But those are always opportunities. So if things get bad and investors want to walk away, down to 3% of the bond price, and sell that thing, that's what we want to add a little bit to that.
Well, I think this chart here, I brought that up. You know, you look at this and this shows you the corporate bond market going back to the 70s. And each of the light blue circles represent the 12-month return following a loss greater than 5%. So if corporate bonds go down 5%, what's the 12-month return for those types of bonds after that? And you see here those numbers, 14%, 13%, you know, 12%, 18%, 31%. So it just tells you that in terms of the opportunity of what this is setting up for is really a nice comeback. You know, once we get to the end.
The bottom of last year, I think it was September, October 2022 was the bottom. And interest rates were rising, insurance were about the world defaulting. Everybody going into bankruptcy and recession coming, which hasn't happened yet. But we'll keep talking about that forever. So we've had a pretty good rally back since October 1st. We've had a little bit of volatility this year with the bank, which we said in March. But had a pretty good rally. So a lot of equities have rallied. Some massive number off the bottom. Which is why you want equities as well. But bonds and rallied back.
Going back to the fund, so you know, obviously the team's got a number of strategies, several different mutual funds. What are some ones that you'd highlight as your current opportunities?
Well, we talk about equity income funds, always a nice way to get some fixed income and no balance fund. I don't have to worry about it too much. Not have to ask about how to yourself. But short-term bond fund, buying 2-3 year bonds on average, you're getting what, 6.75% yield in that portfolio right now. I know that the fund pays like 4.5 or something like that. People say, well, why does it pay 6.5, right? Well, because the accountants pay out the tax yield. So if I bought bonds 3 years ago and they paid 2%, and I'm buying now, they pay 6.5, they're gonna pay out the average of that. They have to figure out what the average of the purchase yield of the portfolio was, and they'll pay that out. But as those bonds from a couple years ago roll off, they yielded 2, and then all the bonds that roll on pay 6 to 7. That yield, that distribution yield will go up. But meanwhile, your total return, what your clients get in the end, should be what, 4.5 of a coupon from distribution yield, and then maybe 2 more points of appreciation on bond prices. So I'm hoping for like 6.5% kind of total return on a short-term bond fund over the next year to 2 years on average per annum. That's a big fat number. Now, we know that if the Fed's going to start cutting rates next year, in the next 2 years, you're not going to see that short-term bond fund yielding 6.5, whatever, it might end up 5.5 over the next 12 months. And so the investors get a little bit less. So I tell them, look, buy a short-term bond, it's a nice fat yield right now, but maybe buy something longer, like 4 plus, that has a little more maturity to it. These are 6-year bonds on average. So you're locking up a 5% yield-ish for core, and more like a 6.25 for 4 plus. You're locking it up for 5 to 6 years. 6% times 6 years, that's 36% over the next 6 years. Not a bad number. Sounds almost equity-like.
I think that's the thing, you know, there's been a lot of people talking about expectations for the bond market. And the thing about it is that it may be a slow grind higher, or maybe it moves, but you're getting that coupon, that income, that's 6%.
Which you haven't had in years.
Yeah, you haven't had it in years, and we just came off of one of the worst years ever on record. Do we foresee that happening again anytime soon? I'd say you probably say no, you know, based on the rate hikes.
No, the Fed could hike to 6%. Let's say they hike 1% more, which I don't think they're going to do, because we know inflation's coming down. Inflation was reported this week, and headline inflation is 3%, the CPI. A year ago it was not. So it's come down dramatically. Core inflation, so excluding food and energy, is 4.5. That's still a high number, but that's going to come down as well. So I don't think these yields are going to, short-term yields aren't going to stay at these levels forever, but these longer-term yields might be in the 3.5 to 4 range for a while. The treasuries 5.5 to 6 for home bonds for a while. So that's an attractive place to be invested.
Yeah. And not years before the equity market.
But yeah, I mean, it's only been a year and a half ago we were looking at numbers that were half this size, and investors were piling in when yields were 3. And now they're afraid to pile in. Why? Because, well, they see money market funds at 5, right? Why not just buy money market fund? Well, because that's great for this year, but that's not a long-term investment. Those rates are going to come down.
What's the average maturity of one?
So that's about 3 to 6 months.
So that'll come down very quickly.
And if the Fed hikes, they're going to get the benefit. Those yields will go up a little bit on money market funds, but then you're getting towards the end, right? Because if the Fed's hiking to 6 or 7%, that means we've got massive rising inflation. We don't. A year ago we did, but oil prices went from 60 to start 2022 to 90 in March of 22 to 120. Remember, they were 120 last summer. Fast forward to today, what are they, $70 a barrel? So oil prices have come back now, almost been cut in half. Housing prices have leveled off. Just in DC this week, of course, I say that. They say, oh, housing prices in DC are crazy. Like, well, there's pockets of, and that's more because there's not homes, and it's not because of growth is not. So growth is actually okay in the U.S. Unemployment is 3.5%. That's a really low number. It means people have jobs. And if you have jobs, they buy things. So the economy's doing okay for now. The Fed's just trying to slow it down, but not for future stuff. They broke it.
What's the difference between, so short term, obviously, you can understand that. What's the difference between 4 plus, and 4?
Sure. Well, I'll do short-term bonds, about a 2-year maturity on average. Yields about 6.75. That buys corporate bonds, that buys some securitized bonds like asset backs, mortgage-backed bonds, commercial mortgage-backed bonds. Core is, and short-term bond is 95%. Right now, it's 95% investment, 85% double yield. So very high quality portfolio. Core bond is all investment grade, so all high quality. But we use investment grade corporate bonds, single A corporate bonds, treasuries, agency mortgages. Really, there's no high yielding core. There's no emerging markets in core. I think they have 1% emerging markets. It's high quality emerging markets. It's basically not. Core plus is more like take your core, which is treasuries, agency mortgages, corporate bonds, and then add in high yield mortgages. So I'd say if you're worried about a recession, which I think would be a soft landing. I'm not worried about a recession yet, given where we are. Everybody's been talking about recession for 18 months. We've had rolling recessions in different industries, but not across the whole economy. But I'd buy core if I'm worried about safety. It's a safer portfolio. Core plus to me is more like I want to get a little high, a little EM. I want a little 1% yield in my portfolio, so I go with core plus. In the long run, that portfolio is probably going to be better because it's got more yield, but it's going to have more volatility, so more up and down. And then corporate bond is like a 7-year maturity portfolio on average. That's about 80% investment grade, corporate percent about 20% high yield. The high yield against single B, so it's not the traditional term high yield. So it's the higher quality high yield. That yield's about 6.5, 6.75 right now as well. So they're all kind of in the same range. That's why when I say that, everybody goes, "Oh, it's my short-term bond. It's less gold. It's safer." But yeah, but the returns might be only last a year or two, whereas yields here might last a little longer.
Kind of a risk spectrum, right?
Because the Fed will cut and short-term rates will come back down. That'll impact short-term bond first.
More conservative with short-term bond, taking on a little bit more with core, then core plus, and then core.
Yeah, that is kind of the risk spectrum.
Wonder who created that song. Let's open it up for questions here. What questions do we have for Steve? We'll get a couple here.
Yeah, just one question. There's this sentiment that, or this maybe hopeful sentiment that the Fed's gonna cut again next year. Where do you stand on that? How do you guys feel, and how do you guys manage to that sentiment?
Yeah, so basically the Fed is probably going to hike in July, maybe one more time this year, so that gets you maybe to 5.5. The market, there's a Fed funds futures market that kind of predicts when the Fed's going to be cutting rates or raising rates or not changing rates at all. I want to say they've got cuts priced in the early part of next year. From my standpoint, the Fed's not going to want to cut too soon. They want to show that inflation is getting back to their target, which is, they say 2%. Now it's a question of headline 2%. So overall inflation is actually getting at 3 right now, probably heading to 2.5 by the end of the year. But core inflation is going to be probably in the 3 range by the end of the year, so still not towards their target. But I think by next spring, they'll be able to say, look, we're at 5.5% Fed funds rate, core inflation is 3. We don't need to kind of keep putting the brakes on the economy so much because the inflation rate is slowing down and the economy will be growing at a slower pace. So they don't want to risk an accident. So I'm going to guess March to June of next year they start cutting. And then by the end of 24, I would probably say 4.5 on a Fed funds rate. If they get to 5.5 this year, it'd be 4.5 by the end of 24. So it gives you 18 months to get to 4.5, but there's a path to get there. I think the market's actually going to be to 4 by the end of 24. But I think that's a little aggressive. Let's read the tea leaves and wait. We don't have to like make bets now on something 18 months from now, But how are we positioning? We're actually been fairly bullish because the economy's been pretty resilient. Unemployment's still pretty strong. Everybody's got jobs, and you want one, you can usually find one. Yeah. And we hear that, and it's a weird situation, right? Because normally when the Fed's hiking, they've hiked the fastest they've ever hiked. Normally the economy would go into the heels of the back, and it comes to let people go. Well, they saw during COVID what happened. They let people go during COVID, and then they tried to hire them back. Because they all went somewhere else, but they went home and said, forget it, I'm not doing this anymore. So, one of those two. And so, companies have been reluctant. I've been everywhere. I was in Michigan a couple weeks ago talking to advisors who have clients that run businesses, and all the businesses are telling those advisors, look, I'm not letting anybody go. I might be slowing down a little bit. I still have to work. I can't lose somebody on the back, so I'm just going to keep. I got to pay them more. And the ones I don't want to lose, I got to pay more. So, it's kind of a weird situation when the economy is slowing, inflation's coming down, but companies are supporting the long cases. The companies that are laying off, the tech companies, they hired massive growth, everybody's working from home, and nobody's buying technology all of a sudden. They're kind of letting part of what they hired go. And then they're also banking, you're seeing banking, because banks are not seeing a lot of M&A activity, so investment bankers, nice investment bank on that. That's a very cyclical business. And so that's where you see layoffs actually dealing with the market. The bigger ones.
know, with it costing more for kind of rates, rates have to go down, and of course, with banks are increasing their CD rate, shorter time frames, all those different factors, does it affect, the bond, our bond style now, especially going into next year when they start leveling off the rate hike?
It's all coordinated, right? Because I was speaking at an event a month ago in Chicago, and somebody afterwards, and I was telling them, look, the rates are going to start falling, short-term rates are going to start falling next year. And the person said, yeah, I did a one-year CD a year ago, that CD just came due. Now I can do a one-year CD at 4.5, like a 6-month CD at 5. And they said, why can't I do a short-term one at a higher rate than a longer-term one? Should I get more? I said, well, normally you would, but not in this environment. So they're starting to see it. So that's the same with bonds, treasury bonds. A 3-month T-bill pays you 3%, but a 10-year pays you 3.8. That's 1.2% difference between long-term and short-term. Long-term is supposed to be above. You're supposed to get paid a premium for taking that extra risk. But the Fed's pushed rates up and trying to squash slow the economy down so we can squash inflation. The long-term bond market believes that. So the 10-year treasury says, yeah, I think inflation's going to come down. But the Fed's not going to lower the front end back down to a normal, what they call an upward sloping yield curve until they see that inflation actually is breaking, which I think it is, but they've got a lot on the line. They got to go on TV in front of everybody. They've already had enough mistakes, I think. They should have been, they had rates at 0 at the end of 2021 when the economy was ripping. They should have hiked then, and we wouldn't probably be in this, well, we'd be in a mess, but not this mess. We wouldn't be hiking to 5.5%, we'd probably be 4.5 now. Inflation went off the rails last year, but they kept priming the pump with money. But yeah, that's what you're seeing. We're seeing the same thing in the CD market, they see in the bond market, which is the farther you go out, the less you get paid. But at least in the corporate bond market, you used to get paid for a bond. Which is funny, so the treasury curve, if a 3-month treasury bond pays you 5%, and a 10-year pays you 3.8. In the corporate bond market, a 1-year bond pays you 5.5, a 5-year pays you 5.5, a 10-year pays you 5.5. It's actually a flat curve. So you kind of get the same yield. Somebody would say, why would I buy the 10-year and buy the 1-year? Well, because what if the 1-year only pays you 4.5 next year if you were to buy it? Why would you lock in 10 years at 5.5? And that's what I'm trying to explain to people. But they're having this hard time thinking about that. So they get 5% on a money market fund. And that's, again, fleeting. That's just temporary. Think about, I remember back in the 80s, we were buying like a 7% seat, 6-month seat when I was a little kid, and thinking this is the greatest thing in the world. They go back next time, it was like 5%, and it was 3%. The rates started dropping. Or you hear about the story about the dumbest guy in the room back in the 80s was the guy who bought the 30-year treasury at 14% yield, and CDs paid 18%. Well, that 18% all of a sudden became like 5%. And that guy who bought that 30-year treasury at 14% got 14% times 30 years. That's like 420 grand. It's a big number. That's a spectacular number, and it'll never happen again. But unless you're Argentina or something. And then you're winning portables anyway, so it doesn't matter. But it goes a little complicated. But yeah, that's kind of, that was an extreme. And guess what happened back then? Some banks broke, right? You borrow here, you lend here. But you borrow here, short term, and you lend here, all of a sudden your borrowing cost goes up, and that's a problem. Now, JP Morgan announced the earnings today, and JP Morgan crushed it. They've got lots of drivers. They've got good risk management. They're a massive bank. So this rates going up actually helped them. For a small local community bank, not so great, right? Because if they've got a commercial real estate portfolio on their books, and commercial real estate sitting empty, and leases aren't being renewed, then all of a sudden they're stuck with some commercial real estate that's struggling. And now you're borrowing at 5% for CDs to finance this portfolio that's struggling. So it's a concern at the local bank level, very small bank.
Coming up on time, just another slide here that we've got. This is just showing you different types of bonds. 1 year following periods of time when we've reached the end of the Federal Reserve, hiking interest rates. And the far right just shows you the average, right? And they show you by short-term bonds, muni bonds, core bonds, corporate bonds, and it's just a natural step of the bar chart. Meaning, the interest rates that you get on money market funds and short-term bond funds, as Steve has mentioned, when we do get to the end of that hiking cycle, we kind of turn the corner, what are you gonna get rewarded for by those core corporate bonds is locking in the types of interest rates that you can have. So, incredible opportunity with bonds, with where we see interest rates and the types of returns you can expect moving forward. Steve, just want to say thanks again for being here. Really appreciate you. I know it's tough to take time out of your weeks, to take time out of your business to be here. So, just a big thank you to you for making the time, for making the trip to our new office. Sad that you couldn't be upstairs, but we're gonna do this again. This is gonna be a reoccurring event that we do, and thrilled to be able to showcase our new building, showcase what Atlanta means to us, and I look forward to continuing to partner with you all as you build and grow your securities business. What we try to do each and every day is to deliver what we call the total client experience. Help you connect with your clients, enhance your business, and optimize your portfolios. Thanks so much, everybody. Have a great day.